Hey everyone, Andrew here from Property Association, and we're just going to have a quick look at the property market, focus on Sydney at the moment, and also ask the question, should you be buying now? For those who don't have time, the short answer is going to be, unless there are particular situations, the answer would be no. For those that actually want to understand how you look at property, what you consider, and why, what happened, why we're here, the cycle and whatnot, please listen. It's going to take about 5 minutes. If you do like these videos, again, subscribe, like, share. Let's build the numbers so it makes it more viable for us to keep looking at different areas within property. So when you look at the property cycle that we've had recently, what you can see is that with the trend and the big spike that happened between 2012 and 2015, what you found was that you had about a 59% increase in prices. So it's really important to understand what's happened and why we are where we are now and what you should be doing. So if you then look back 2000, 2003, which was the previous boom, there was an increase in apartment prices by 61%. So very similar period of time and very similar amounts in regards to increasing. Same with housing. Housing recently increased by about 40% and previous boom was 42%. So you can see that cycle in the pattern. Now, in 2015, when we hit our peak, there was a correction. So every cycle, once you hit the peak, there's a correction. That correction was about 3.5%, lasted for about 6 months, and then bang, up it went again. That second spike is an anomaly. It's something that I can't really find in previous cycles happening to the degree that it did. So with apartments, you had it hit a high in 2015, dropped 3.5%, and bang, up 19% in a year and a half. So that is what you could probably argue is the adjustment that we're having now. So if you look at where the prices have fallen and by how much and sort of where they're hovering around, I think it's not unrealistic to expect overall apartment prices to drop by about 15% and housing prices, about 10. And that's just going to reflect that extra little spike. So why did we have that little extra spike? I mean, there's no simple reason, and like most things, property is a demand and supply criteria. One of the differences with property is that it's also a wealth distribution item. So when the world's wealth wants to come to Australia, then it's going to drive our property prices up. So it's not just a demand for a product, but it's who is also demanding that product that will dictate the spike. So in 2014, what we saw was an extraordinary influx of foreign buyers coming, especially buying in Sydney. And as a consequence for that, those numbers were really strong 2015, 2016. Now in 2016, in 2015 when the correction sort of started, then in 2016 we had 2 interest rate cuts. Traditionally, interest rate cuts would mean economy's not good, be cautious, and the market would pull back. But we still had that strong demand from overseas, and there was a 25% underlying demand from overseas buyers. So it really boosted that demand, and all of a sudden the prices kept going. So even though the government introduced a 4% tax on foreign buyers sort of mid 2016, it really didn't do much to slow things down. And also, even though the banks started to make it a little bit more difficult for them to acquire funds, it still didn't slow it down. Then in 2017, the New South Wales government increased that tax for foreign buyers to 8%. So you and I, we go buy an investment property for $1 million, we pay about $50,000 in stamp duty. For the overseas guys, they're paying 150. So it's 80,000 more, sorry, 120. So it's a huge amount, 8%, and that's really just dropped off, and that killed really just halted, bang, right there. Demand dropped, prices just started to fall after that, and we start to fall into the cycle that we are now. And not only did that underlying demand, which was at 25% for city property, get to under 10, so now you don't have that propping up the demand, but locally we started to find it harder to get financed. The bank was saying, well, if you're an investor, we still want you to have interest and principal loan. So we want you to be putting more money out of your pocket in. So all these property people, as you call them, because you've got to have a certain psyche to really want to take on the debt that's involved in owning property as an investment. They were really accumulating all this credit and buying properties, and when that halted as well, we actually found that investors almost just totally dropped off, and the market was left with owner occupiers, and it was never going to be enough to soak up all the construction and development. So construction and development is this huge monster, that like a big ship that you can't just turn it around easily. So once all this demand was in place, all these DAs hit, all these builders were at stages where you just can't stop. You can't, if you've demolished what's on the land, you're not generating an income. You need to build it. If you've started building, you've got to finish it. So all of a sudden you had all these projects, even though the overseas and foreign buyers had backed off, the investors had backed off. All these apartments were due to complete, late 2017, a lot last year and a lot this year. And this is where we've seen that oversupply, because we just don't have the demand to soak them up quickly. And now as a consequence, we're seeing that huge, ship, cruiser, imagine a big cruise ship, which is construction, literally halt and slowly turn around, and basically where it stopped. You're not seeing a lot of holes in the ground. You're not seeing a lot of new places being demolished. And that's where property is this interesting beast, because what will happen is that the existing apartments that are finishing now will be soaked up in the next 9 to 12 months. They will be soaked up. And then where is our next round of properties? When people then say, but I want a brand new property, it's not going to exist. The best they'll be able to get is something that's 1 year old or 2 years old. And then that demand for off the plan and new will start to creep in. But again, it's going to take a long time for construction approvals to recover. So, construction approvals have plummeted from last year to now. And that's just part of that sentiment. So if you're asking what's happening with the market, it's a bit of a Mexican standoff at the moment between, you've got developers, and the developers that we're dealing with, a lot of them launched these larger projects in 2017 or late 2017. So the prices were much higher. They adjusted the prices in 2018 slightly and got a few more sales. And now that they need to adjust them even more, they're thinking to themselves, well, if I sold units at 600,000 at the end of 2017 and I'm now selling them for 530,000, how will those purchasers from a year and a half ago be able to settle? They won't, because the valuations are going to be the next issue. The valuations are going to come lower, and as a consequence, they're going to lose those sales anyway. So they're opting to, rather than sell 3 or 4 properties a month, they're opting to sell 1 property every 2 months at slightly higher prices, just to maintain the valuations in the building. Now, once the building completes and they settle all those old purchases, then they got the decision to make. Do we drop the prices to meet the market, or do we just rent them out? And what we're finding with developers who are completing property at the moment in that scenario, a lot of them are thinking, well, the interest rate is so low, I can opt to hold the property. Because as a business, when I purchased this site 3-4 years ago, I ran a feasibility. A feasibility is basically you input the purchase price of the land, how many units, the cost of building the units, what you think you're going to sell them for, what it's going to cost you for your DA, all that stuff, and then it spits out a number that says you will make 25%. So you'll make $6 million. So a lot of them saying, well, if I drop the prices, I'm nowhere near this feasibility, and it makes the whole exercise and risk that I've taken really not worth it. So I'm better off to rent out these properties, and I'm actually starving the market of property, and I've been in the market long enough to know that it will recover. So that's the dilemma that developers are in at this point in time. So that's why I started off by saying that, in short, would you rush into buy now? No. But does it mean not to buy if the circumstances call for it? Of course not. What does that mean? If you've inherited money, should the money be in the bank or be in a property? In a property. You can tell we're so close to the bottom of the cycle. You just got to go in and be a lot more aggressive when it comes to your negotiations. You got to literally, look at your information, go out there, and the best thing about it is now you can negotiate. 3 years ago, 2 years ago, the real estate agents weren't even calling you back, but now they will, and you have the ability to negotiate. You have the ability to take your time too. No one's going to rush you and say, "Oh, if you don't sign now, someone else is going to buy it." And if they do, call their bluff. And if somebody else buys it, it's probably 1 in a 100 chance at the moment. So you've got the time to make the decision that you are looking for, and you also have the ability to negotiate quite strongly. So my advice is, if you've got some funds, not sure what to do with it, you can start looking now, aggressively negotiating if you find something that ticks your boxes, but just make sure you've done all your homework first. When do I see this all changing? It's a little bit too soon to tell, because a simple change in funding policy, and APRA came out the other day saying that they're going to look at easing up in terms of the serviceability criteria. Anything that changes that criteria and brings back the flow of credit will make a huge difference. The question will then be, have we learnt our lesson, and has the banks learnt their lesson, which is, if somebody is borrowing money for a real estate transaction, that's fine. If somebody's re-borrowing against an existing asset to fund a holiday or to fund a car or to fund lifestyles or whatever it is, should we really be doing that? And should we be looking to pay off a minimum amount of that loan within a certain time frame, or are we just accumulating credit over credit over credit? So interesting times at the moment. Any questions, let me know. Any comments, let me know. If it's helpful, please let us know, and we'll keep introducing some more topics. If there's topics you like, let us know. Subscribe, like, share, and I'll be in touch soon. Thanks.